So good afternoon, everyone. The name of today's right now session is How Private Equity Fund Works. And I'm Hetal Pandya, and I'll be the moderator for this session. We have panelists with us today. The name of our panelists are Vishvesh Sharma, Senior Associate of Lighthouse Funds, and Deepak Sharma, Investment and Finance Manager of Business Oxygen Private Limited. I'd like to welcome you all to this session.
Thank you.
Thank you. As for our attendees, I would like to say you may ask specific questions at any point during the session by writing them on the Q&A section, and we will try our best to answer all the questions. And I personally encourage to ask questions and get the best out of this opportunity and make this webinar much more engaging and insightful. We will start. We'll start off with a brief history of private equity and how the industry began, and we will talk about how private equity they do diversifications among their funds, how they deliver returns, how they drive into the mechanics and structure into the firms. We'll cover the strategies and how individuals can access the private equity firms. And we'll end the session with the question and answers. So I'll first begin with the very brief history. The private equity investing was started by late 1800s and early 1900s in the United States of America. And the first equity buyout was delivered to be by the JP Morgan to the Carnegie Steel Corporation and for $450 million. Later, it was merged with the US Steel Corporation. And until in the late 70s and early 80s, there was not so much specific things going on in the industry. The firms really started to specializing in the private equity was investment banks, and they became the predominant players. And ever since then, they are the real market drivers as far as the investment industry is concerned. Now, I will start my questions to each of the panelists, and let's begin. So I'd like to know, as per the layman's term, like, what does the private equity do? Like, for an outsider, many of us have the perception that the firms with having big funds are looking for investment opportunities. But we would like to know from somebody who is a part of the firm itself and get the insights into the private equity industry. I would like to start with Deepak Sharma. Thank you.
Thank you, Hetal. Thank you for the question. And private equity as such, I'm from Nepal, and in Nepal, private equity is not a very old concept. And in fact, in terms of investment per se, it started from the year 2015 only. Before that, it was peer-to-peer investment. So here the confusion starts, how different is peer-to-peer investment from private equity? Private equity as such is the investment in a firm where the investment vehicle is institutionalized, which is the PE fund. And in the PE fund, there are LPs which put money into it, which LPs can be high net worth individuals or the pension fund or FDI coming into it as an individual or as a company, or DFIs per se in economies like Nepal, which is just starting to grow. In these kind of countries, the DFIs have the impact angle as well, and they are also one of the major investors here. For example, IFC, CDC, DFIDs, and DFID now are replaced by FCDO. So here they pool a fund in a firm, private equity fund as such, and fund manager, there is two concepts. Fund manager is known as general partner, and general partner also have some small portion of the investment into the fund, and they are responsible for day-to-day operation and management of the fund. So portfolio management or day-to-day operation or deal sourcing, monitoring, exit, all these decisions are made by general partner, while LPs are the investors into the fund, and they may sit on the advisory board and supervise the operation of the PE firm. So this is the structure of the PE firm, and how PE firm invest is PE firms can be sector specific as well or sector agnostic. So depending upon what their investors mandate are and what the criteria they are into investing, and they have their specific mandate into selecting the companies as well, which stages of the company they want to invest in. So in country like Nepal, where there is very thin distinction between venture capital and private equity, because the ticket size is very small and our GDP as compared to India or bigger economy is very small. So here the line of distinction is very thin. So I leave up to the audience to decide what is if they categorize our company as a venture capital firm or private equity firm. But we like to say we are private equity firm as such. And our mandate as such is we invest in SMEs that are registered in Nepal only. And our investors at Business Oxygen, our investors are IFC, International Finance Corporation, which is a sister organization of World Bank, and DFID, which has been converted into FCDO lately, and then Pilot Project for Climate Resilience, which is a project of World Bank, which has now converted itself as Climate Investment Fund. So three DFIs came together to form Business Oxygen Private Limited in Nepal. As such, the idea was to start a private equity industry in Nepal. So the first impact was to create a different arm of investment so that SMEs could have access to different vertical of the investment source. So this is how we started. And since our focus was on SMEs, so our ticket size started as $100,000 to $500,000. So ticket size as such is very small as compared to what PE is supposed to invest and is supposed to know to invest outside. And in between our investment period, the policy was changed that since our firm is FDI based, no FDI can come into a country unless it's $500,000 was the mandate that was changed by the government. So then onwards, our average deal size started to be either $500,000 or more than that. So this is how we started to invest. So this was the brief introduction of how private equity structure is formed and how Business Oxygen is operating as such.
Thank you, Deepak. Thank you. It was a great insight and introduction for us. Now, I'd like to ask the same question to Vishvesh Sharma. What are your take on this?
Sure. Thanks, Hetal. I would also like to thank the entire Growcent team for giving me this opportunity to speak at the South Asia Investment Summit. I think it's a wonderful platform that they brought together. I think Deepak has covered the functional aspects of a private equity very well in terms of explaining how there are LPs which have large pools of capital, which are essentially HNIs or university endowment funds, that's more common in the West, who are looking to invest in particular sectors. And because of this, they give their money to GPs who are essentially the private equity or the venture capital guys, who then look for specific investments. For example, I come from a fund that looks at consumer investments particularly, right? So any LP looking to add a consumer paradigm to their portfolio will give us money, and we will, look for particular opportunities in the consumer space, invest their money, manage those companies, grow them, exit them, and then return their money. In terms of returns, we typically return the money from a particular fund. So for example, I come from Lighthouse. We are operating out of our third fund. So LPs invest in particular funds, and then the minute we exit a particular fund, we repatriate the money back to them. What I would like to definitely touch upon, right now is how do we make these investment choices and these decisions? Because I think that's interesting, and it's something that differentiates our philosophy as a consumer fund. So to give a little background on Lighthouse, we are about $500,000 in AUM, and we are backed by marquee global investors. In fact, IFC, as Deepak mentioned, is one of our LPs as well. And we invest across the consumer theme. So in terms of, a few representative investments, we've invested in the personal care space in a company called Nykaa, which has, been in the news these days because of their public listing, and in a company called Kama Ayurveda. On the lifestyle space, we took an early bet in a company called Fab India, which I'm sure all the participants would have heard of or used at some point in their consumer journey. And also, in a mattress company called Duroflex. And on the healthcare side, we've invested in Tylenol Orthotics and a company called Poly Medicure. Now, let me quickly run past the 5-point checklist that I typically use while making these investments. And while it is a 5-point checklist, it's not as black and white. It's pretty subjective. And even after years of experience, I think at the end of the day, when we write a check, we keep our fingers crossed because it's a bet that we are making. So I think the first important attribute is product, and this is critical. So we try and understand, as an industry evolves, how does a company's product evolve with it? And here what excites us is a company that has a strong product moat that cannot be replicated in any remote lab of the world. So let me give an example to the listeners, right? I spoke about a company called Kama Ayurveda as part of our investments. So Kama is one of the most iconic luxury personal care brands in India. And it develops its products with extreme scientific rigor using the science of Ayurveda, which is very hard to come by. And this science empowers it to position its brand as something that's therapeutic, that's luxury and hedonistic, a story that not many companies can tell. Even their tagline goes as authentic, Ayurvedic, and time-tested. So it's really a testimony of the brand salience, which gives us comfort behind fueling this company with capital. I think the second factor is there enough growth left after 5 to 7 years? So typically as a PE fund, we have a 5 to 7 year time horizon. And while we get very excited by seeing the historical year-on-year growth, which is very, very important, what's equally important for us is to tie this growth to the overall market, which in private equity parlance, we call the target addressable market, to see if there is enough steam left to propel the future growth of the company. As Deepak also spoke, as private equity investors, we typically play the game of, buy, build, and sell. And the build angle becomes very, very important for us, where we roll up our sleeves, we drive operational improvements, scale the company, and then derive our commensurate returns. So typically, I like to see the company having a certain path of growth once I enter, which will give me a good return on exit. I think the third factor, which is a derivative of 1 and 2, is strong financial statements. And let me first talk about the profit and loss. Now, we appreciate that the profit, the cost, and the margin profile varies from industry to industry. To give an example, in the personal care industry, gross profits are as high as 70%. But in the durables industry, they could be in the range of 40 to 50%. And we understand that. But what we want to see in a company is its maturity to reach a stable financial profile wherein it can start generating operating leverage. And let me simplify this for the listeners, right? What I mean by operating leverage is that at a certain cost base, the company can continue to grow because of its brand salience and brand equity. And the way we gauge this as investors is we evaluate their retention and their repeat metrics. So typically we see that, in a consumer journey, a consumer who started using that product in a particular year, has he stuck with that brand or has he moved to another brand? Because if you can retain your customers in a consumer business, I think you're home and you've really won that battle. The fourth is again related to financial statements, but is the balance sheet. And this becomes very, very important. And here we evaluate two things. I think the first is working capital. We try and see if the company generating organic sales or not. And let me take a step back, because this is very important in today's day and age of, the direct to consumer era, as we call it, where we have all these online companies, right? Because there's a concept of primary sales and secondary sales. So a company will sell to an Amazon or a Nykaa as a primary sale. And Amazon or Nykaa will sell to the customer, which is you and me, as a secondary sale. Typically, we try and analyze the difference between the primary and secondary sale, because if we see a very big deviation, it gives us a red flag that the company is stuffing the channel with its product, but the consumers are not buying that. In the erstwhile private equity era, we used to call this the debtor days concept of working capital. And I think that's very important for us. The second part of balance sheet is the return ratios. And typically we evaluate the ROEs and the ROCs. In a layman's term, what I look at is how the company uses the ingredients of debt and equity to generate its cash flows. Now, I know with frothy markets, the burn to earn concept is popularized. But I must say, as private equity investors, cash is very, very important. We really like to see companies with a robust cash balance, or at least an ability to generate one. In fact, as an investor, one of my favorite quotes goes as revenue is vanity, profit is sanity, and cash is reality. And I think I really believe in that, and especially in today's market where I understand growth is important, but at some point the business does need to make money. And as private equity investors, that becomes important for us.
Right. Cash is the king, as what they say.
Absolutely. Absolutely.
Yes. Great. Thank you. So my next question is, it's a bit of an hypothetical question, different than what previous question was. Like, there is everywhere there is a talk, like the market is sort of a heat in the moment, like everywhere people are raising money and going public and raising big funds. So what is your take in terms of post 27 and pre-COVID and post-COVID scenario, as far as India and neighboring countries are concerned? What do you think? What are the challenges for a private equity firm to raise funds and then invest to the great money-making companies? I would like to start with Vishvesh, of course.
Sure. So I think let me answer this in two parts, right? The first part is how does the dynamic play out for us as investors in terms of the LPs giving us money? And the second is in terms of us investing. See, in terms of the first part where LPs are, looking to invest their money by giving it to private equity investors, I don't think there is any inhibition in investing. I definitely think that the narrative has changed now to one of more caution and thoughtful investment, especially in the PE space. Also, as LPs, they are very categorical. If they want to go behind the whole burn to earn, as I mentioned earlier, investing vehicle, they go to a venture capital and they will not come to a PE. Someone who is giving a PE money will give money behind a thought of getting returns in the next 5 to 7 years. And given the next few years will be choppy for most businesses, companies will not give us money to invest in high burn tech businesses. They will give us money to invest in businesses with strong fundamentals, strong balance sheets, strong return profiles. In terms of us investing, definitely, last year was a challenge because, COVID took us all by storm, including the investing community. And we really used that time to, sit back and reflect on what we need to do, especially with our portfolio companies, to drive more business resilience. But I think now, as the situation in India is improving, we've become more confident to invest in companies that have a stronger financial profile. And that's actually instilled more confidence in us as PE investors to stand by our roots of healthy EBITDA margins, strong working capital, strong returns, and not go in the whole frenzy of market froth.
Okay, thank you. Deepak, what is your take on this? What do you think? What are the challenges that are being faced by the private equity funds to raise funding? And that would be specifically to the post-COVID and pre-COVID scenario.
I mean, fundraising for private equity is basically dependent upon their performance in the past funds. So in this COVID situation, I mean, it has been a boon in disguise as well for many of the private equity firms, where they could get hold of the asset in distressed value. And this is a temporary situation, right? So after a certain time, they will again get the right valuation, and they may enter at the low valuation and exit at the high valuation, which will in turn give a higher return to the PE firm, and that will be reflected on overall IRR of the fund, which will help them to raise the PE funds. But as a person, as a firm, we almost depleted our 70% of the fund before this COVID era. And now we are looking forward to pitch for another fund. So during this time, maybe I can answer your question quite precisely. And a lot of investor assets, they are in the situation of wait and see. Because initially when this pandemic started, people had a feeling that it will be just 6 months or a year period and it will go after that, but it hasn't been the case. And this has really affected the regulatory processes in terms of PE firms, which recently secured their capital from the investors, but haven't been able to invest because of the regulatory hurdles. Departments are working, government regulators are working in limited time frame with limited staff, and the services is being disrupted. And as such, even PE firms are not in rush to start right away because they don't know which sector to go in. At the current situation, sectors like edutech, health tech, IT, they are showing counter-cyclical kind of effects. But the consumer goods or other kind of regular traditional businesses, they are having a negative impact, and especially in Nepal, where much of the businesses are related to tourism, and tourism has been severely been affected. The whole economy has suffered as such. So in this situation, it is, I mean, very tricky to answer precisely, but at the moment, raising the fund as such will not be dependent upon this disturbed period or the performance of a fund in this period itself. But when we see the bigger picture, this can be an opportunity, as well as also depends on how resilience or how the strategy of the PE firm is very matching to the portfolio company, how they have been able to hold hands of the investing companies during this time, and how they have been able to bring them back to the regular businesses from this current pandemic situation. So I think this will be a real test of fund managers, so that the investors or LPs can also decide whom to bet their money on. And those who have the knowledge of the industry, who have been together with the investing companies, instead of pointing fingers on someone, I think PE funds can have good opportunity from this situation, and can help themselves on raising further funds as well.
Okay. So now I'd like to know that who typically invest in private equity funds? Like traditionally, we know that large public and private pension funds and some international institutions that you mentioned earlier, and some of the family offices and high net worth individuals. Now, I would like to know that do they come with teams of people dedicated to the asset class? Like how the whole process looks like how the commit capital and investment capital differs in terms of layman's terms, right? I would like to start with Vishvesh.
Yeah, so I don't think the LPs come with specialized sector expertise, which is why they divide their entire capital base into different funds. For example, an IFC or any other LP would give its money to multiple private equity funds with specialized expertise. Some are, of course, sector agnostic as well. To give an example, an LP can invest in a healthcare specialized fund to make the healthcare investments. They'll probably give Lighthouse, which is my private equity, funds to invest in the consumer space, and another one to invest in the tech space. Now, the expectation to drive these operational improvements and have sector expertise, that lies with the GP and the GP's team. And the GP is essentially the private equity fund. So once we make the investment, we sit on the board of a company or get a certain representative position, and we work with the promoters to build their business and to scale it. And we do this because of the experience we garner over the years in making multiple investments and studying the sectors closely. But I don't, of course, the LPs would have experience in the sector, but they don't necessarily need to come with a particular sector expertise.
Deepak, would you like to share some of your insight on this?
Okay, so like for us, I can say that we were one of the first private equity firms in Nepal. And in Nepal, since the market is very small, sector-specific funds have not started yet. And whichever the funds are operating in Nepal right now, they are sector agnostic. And when there is sector agnostic, we have the limitation on our own capabilities as well. So when IFC started this fund, and we had rounds of communication with them, and it was clear that even their expertise, sector experts, like in terms of agri sector or sector experts from IFC and World Bank, would be catered to provide the services to the investee companies. And from our side, I would say, like, if we had a specific expertise and money as well, but we would be running the business, right? So if we are sitting and working as a private equity fund manager, we have our certain limitation on the role on the operation side. So our expertise majorly come from the at the strategic level. And if there are deeper holes to be plugged in, or if we had to go deeper down into it, then we are the linkers, where we know the set of the experts whom to use, how to use it. For example, if one of my company is trying to go into international franchise, so he doesn't have any experience about it, then I get that. I pull in the franchise expert, I get the legal person from there, I draft a structure, and then we sit together and which one will work for us. We'll decide on the commercial aspect as well as the legal aspect. Do not have all the expertise that require for over the different sector of the investment they make. In our case, we have 17 investments across different sectors, be it energy, take, health take, manufacturing, a food business, and a lot more. So I don't say that we have the right expertise, but we make a point to fit the right person at the right place, and we try to link them with the right person in the value chain, right? So some of our portfolio company may be the user of the services of other portfolio companies. So we try to act as a connector. And for our specific case, in our case, IFC has been very helpful, and their local resource person and all of them, they have been supportive, because this was the first pilot project in a way. So there was help from the LPs as well, but this is not the typical case, as Vishvesh mentioned. Since LPs will be backing on the GP's expertise, that's why GPs should be more robust on it and hands-on on it. But we have been fortunate on that aspect as such.
Now, I would like to ask you a question about, like you mentioned, that strategic and operational building that the company you invest in, it's in the expertise of private equity. I would like to know that how you build a company operationally, like how do you make it more robust in terms of launching them in the market further before you exit and sell the company and make money off that firm. I'd like to ask to Vishvesh.
Yeah, so I think that process really varies from company to company, and it's not a straitjacket solution, right? But before we invest in a company, we understand it's not a perfect world, and there are certain nuts and bolts that we need to tighten. And we have that candid conversation with the management, saying that this is the the 100-day plan, typically, as we call it, to try and set a launch pad for the next few years of growth. And we identify certain levers that need tightening. So in some companies' case, it could be product, where we feel that the company needs to beef up its new product development pipeline. In another company's case, it could be marketing, for example, where we feel that the company needs to develop a more robust go-to-market strategy, or it needs to go from print to digital marketing, or vice versa. Sometimes especially in the early companies, Series B and onwards, we also see that the company needs to beef up its team. So before we invest, we meet all the CXO level heads, and we identify certain business functions that are critical to the operations that probably need more support. And in that case, we also drive certain hiring processes with the founder, where we set in place a marketing head, or a finance head, or a supply chain head, and then we drive the business. So to sum it up, it really depends from company to company, but we try and at least fix the basic divisions of a company, which is sales, marketing, finance, operations, and supply chain.
Deepak, would you like to share your opinion on this?
Okay. So when, as you rightly mentioned, when we invest in a company, we invest with a point of view to get the return when we exit. And there is a limited time horizon in which we have to exit the company. So we don't have a lot of time to grow the business, exhibit the increase in the valuation, and then make our profit. So it's typically 5 to 7 years of time period in which we have to do it. So for us, how we can ramp up the company's valuation comes from the idea what is the need of the investment and how the entrepreneur is looking forward to use the investment, and what is the effect of that investment once the investment is into the company. Is it to the increase in the efficiency of the company, reduce the cost and ramp up the bottom line, or is it to the expand the top line and increase the business by expansion? So what is the come from so what he is trying to do with the investment? It is not that always the investment they demand is justified. So at times people just get whimsy and they are looking forward to get the investment. They are looking forward for $1 million. But when we deep dive into the financials and their strategy, and when we analyze it, maybe the company doesn't even require any investment as such. So we see what is the impact of the investment that is going into the company and how the investment utilization is going towards. So as Vishvesh mentioned, so most of the time, if the investment is going towards the product diversification or addition of the vertical, then we see if it is related to their field of expertise or not. If that investment, they can digest the investment to exhibit the target as they have explained in the business plan. Or second is, if there is going to be any replacement by newer technology that will lead to the process efficiency, increase in the installed capacity, or any kind of efficiency or economies of scale that we can garner from the investment. And another is, we always say we're not investing in a company, but we are investing on entrepreneurs. So it has to be entrepreneurs' passion and their capacity to manage the business and adapt to the bigger picture. Once we invest, the company has to move from current level to so we see if the team is better aligned to achieve the bigger target or not. That's when they had only one outlet. And as they
there seems to be some connectivity issue from Deepak. Am I audible to you? Maybe you can turn off your camera to
I can hear you.
Okay, we can't hear you properly, so there seems to be some connectivity issue. Hello, am I audible, Deepak? Okay.
Deepak is having some technical issue.
Yeah. Meanwhile, I'll have to start with one question. Since we've spoken about companies, I want to target the elephant in the room, like how private equity investors are approachable by the companies. Like, what are the standard procedures? Because everybody here wants to know, like, how to catch the attention of a private equity investor. And Vishvesh, I would like to ask your views on that.
Sure. So I think, my advice to all the aspirational founders out there, my first advice would be invest in yourselves and your companies first, because I think that is the biggest asset that you will create. Because as investors, and I think Deepak also touched upon this briefly, the most critical factor for us becomes the quality of the management and the promoter. And what we look at before, I mean, the key factor, besides, of course, all the financial aspects, is the management, integrity, and intention. And what I mean by this is, once, we tick the boxes on the financial aspects, we have a very candid discussion with the promoters where we see if there is a certain meeting of the minds with the way we envision their business to grow and the way they envision their business to operate. We also see if they, prioritize certain spendings. For example, if we are evaluating a healthcare company, I would want to hear the management talk about investing in R&D, building patents, and really investing in their business. So I think that's the first thing that they need to do. Once they do that, in terms of approaching investors, there is a certain standardized industry process where there are investment bankers who run processes for us. where they can approach these bankers and, we typically have good relations with most bankers and we're in touch with them on a daily basis. And they tell us what opportunities best fit us. And of course, which investors are the best for the firms as well. I think this is, again, as I would like to add some pun here, a marriage with a destined divorce. But I think that marriage is very important. I think it's very important for not just us to find the right firms, but even the firms to find the right investors. And I think bankers are very helpful in that aspect to facilitate that process. Other than that, I think the whole network effect that PEs build, for example, I think Growcent has done a fantastic job by organizing the summit. I think by attending such summits, they can get to know more about our psyche, how we look at businesses, and connect with us, and see where they are in their entrepreneurial journey and at what stage we can partner. So I think, to sum it up, having strong connections with the investment banking community and building a network directly with investors who are very friendly, by the way, are two key ingredients to prepping your company for fundraise.
Thank you, Vishvesh, for your views about Growcent. We really appreciate it. Now, Deepak, I would ask you, what creates that urgency for you to look for the company that you invest into? What creates that first impression, according to you?
Okay. When we are looking for investment into a company, first we want to know how candid is the founder about his business. If he is trying to hide things or if he is not willing to be very transparent. So this is already a red flag for us. So if he's planning to raise a fund from an investor, then he needs to be very clear in his head that he wants to be very transparent, because here we are trying to grow the business together. It's not, though initially it seems like we are on the opposite side of the table, but the exercise is to be on the same side of the table at the end of the day. So unless he is very transparent, and equity investment, typically here for us to invest, it takes almost 3 to 6 months. So during this process, we have different meetings and we do our own due diligence and all this. So it's about reading between the lines, right? So in one meeting, if he's saying something, and in another meeting, if he's saying another thing, then it's already a red flag for us. So he is not consistent with his own statements. Then we want to clear that things up. So first, the intention of the promoter is very important to us. And we want to have our background check with their suppliers, bankers, and the consumers as well at times, if that doesn't hamper his confidentiality terms. Then the second thing is, as Vishvesh mentioned, we are not into venture capital or seed capital investing. So there has to be a very robust financial when they approach us, because we want to invest in a company which already has a proven track record. It's not that we are looking into startup ideas and we're not looking into the prototypes or MVPs. So this would have had a track record and it should be reflected on the balance sheet or financials. But the problem in Nepal is most of the businesses, they don't have very transparent books. So there are dual set of books, and that's when the tricky part is there. And they say, like, on my audited set of books, this is the figure, but my actual is like this. So that's when we have to go deeper into it. And since this is very in a nascent stage, and most of the finance professionals, they themselves don't know how to dig into it, and we have to get ourselves on the ground and work in tandem with the due diligence auditors at times. And we need to figure out from the bank statement or purchases if the figures they are saying do match with their bank statements or not. And many of the transactions are done outside of the bank accounts as well. So it's really tricky in this part of the world to decide what to look into. But more basic factor, the most important factor for us comes from the passion and the intention of the promoters. And when you are dealing with the same person for a quite a long period of time, then you can figure out if how innocent or how diligent is that person, and how robust is their finances. Because in the 6 months period during your review, you can see how much sales they have been making in this period, even though you don't have the data on the past that very clearly, but you can analyze the period in which you have been reviewing the company. And then there comes what is their vision going forward, and how the investment utilization is going to be, and how they plan to expand their team, who they are backing on. So all this factor summarizes in the fact that we will be investing on the entrepreneurs, not the company as such, because if the entrepreneur is not the right person, then the company, however good, won't stand.
Right. So, before I jump to the growth equity topic, I would just like to ask one technical question since we're talking about the companies approaching the investors. Like, according to you, what should be the ideal presentation or pitch deck that creates the fear of missing out to any investor in the first glance? I would like to understand, like, is it the details or the visual things on the presentation and the relation between them? Like, I have read somewhere, like, if you let your audience read a lot of things on your presentation, you already lost them into a lot of details. What creates that fear of missing out at first glance? As apart from this entrepreneur and the strategy and cash, what are the deciding factors that makes you as an investor to sort of approach the startup founders and people? So I would like to start with Vishesh.
Yeah, Hetal. Yeah, Vishvesh, I just want to interrupt. As we all know, Lighthouse is a growth equity fund. So I would like to know more in detail about this. What is growth equity and how it works actually?
Sure. I'll cover both the parts. So Ketan, your first question on what is sort of the secret sauce of the first pitch.
Mhm.
I think if it's one word for me, it is clarity. Clarity is extremely important, and I think clarity comes in a lot of ways. One of which is being succinct, as you mentioned, right? Not giving too many details. And I just think being honest about where you've reached so far and where you want to get. Because what happens is that as we're investors at the end of the day, we're not industry technocrats. We don't understand the technicalities of all the industries, right? And at times we get decks from investors who have very complicated businesses in maybe hydroponics or packaging or other complicated sectors. Now, it is what really impresses me is their ability to tell me their story of their entrepreneurial journey so far, the product, the team, the vision they built in simple and clear terms. So I think here, less is really more for us. Because once we see that, it's a visionary business, of course, then we have these detailed meetings where we deep dive into different aspects of the business. But those details don't catch attention initially. It just makes us lost.
Right.
So that I hope that's answered your question.
Yes, it did.
Shahu, do you want me to answer your question right now, or do you want Deepak to first answer Hetal's question and I can come back to it?
You can carry on, Vishesh, and we'll go to the Deepak after this.
Sure. So I think Shahu, your question was growth equity investing, and I think I did talk about this in my initial answer, right? The first discussion that I had. See, as growth equity investors, typically we enter at series B and C onwards, and we try and enter companies who are already profitable, ideally, or have a certain path to profitability, because we like to exit in 4 to 6 years maximum. And in those 4 to 6 years, we typically like to have clarity on where our capital will be deployed by the company. Is it going to be in building the product, the sales, the team, the R&D, what exactly it is, right? And what we do is we help the company identify that. We help the company make those investments and then grow from a certain scale and size and stage of business to graduate. So if we enter at Series B, by mixing all these ingredients, we make the company, increase its valuation and reach maybe a Series C, Series D investment. And then we exit by either selling it to another investor, could be a financial investor, could be a strategic investor. At times, if we get lucky, we also list the company on the bourses. To give you an example, Nykaa is one such company, which is now going for a public listing. And I think, we work with these companies to help them graduate. And in the process, we enter at a certain valuation and we exit at a multiple of that valuation. And that is how we derive our returns. I think the underlying, especially for Lighthouse, I think our underlying philosophy is to build businesses. Even our tagline goes as dream, dare, scale, and care. And that defines growth equity investing. Because we dream big, we dare to implement it, we scale the company, and we care for our promoters. I think that's the essence of our process.
Thank you, Vishesh. Deepak, would you like to jump into this topic?
I think
First
Vishesh,
about the growth equity as well as about the presentation part.
so I think Vishesh very much summarized quite well in his answer itself. So the fund investors are already overwhelmed with a lot many investment requests, right? So you have to be very specific about what you want to tell about them, tell to them. So it has to be very catchy in the first presentation that will intrigue the investor into getting deeper into your company. So they don't want to be overburdened with the information, and like you mentioned, technical aspects of all this information, because the one who is listening to your pitch or who is reviewing your presentation is the person who is more into numbers and investment. So he doesn't want to get into the details as such, where you'll throw them the technical jargons so that you will have the impression that you have the sound knowledge of the background or your industry. But you want to be very specific about what your investment needs are, how your company stands out from the crowd, and why the investors should be investing into your company. So if there you can create the interest in the investor, then they will definitely come and dig down further. And there is a lot of process where you can explain the other part of the information. So you should be knowing, like Bishay said, less is more. So what you want to fit in that less is very important.
Okay. I would like to pretty much ask you if you have any particular topics that you would like to talk about at this point until we questions, if there are any.
So from my side, whenever equity investment is concerned, it's unlike debt investment where the investors or specifically banks, they provide the debt investment based on the collateral and they are on the safer side and they're only interested on their return. But in equity investment, it's completely different angle. And in this pandemic, during my experience, the companies which have been severely hit are those companies which are heavily indebted. So having a knowledge of capital mix and what is the right capital mix for your business is very important, and what much of the equity and debt component you want to have in your company, because you never know when this pandemic like situation or when there is any kind of business disruption in your particular industry is coming ahead. So you need to be prepared for this. And equity investment as such is definitely costlier than debt investment, but you need to understand this is completely different than the debt instrument, right? So what is the right mix for your business and what you are getting into it, you need to have a detailed understanding of this thing. So just based on the cost of the capital, you should not be making your decision, but your decision should be very rational. And apart from that, I'm not sure if other LPs also come with this, but in our particular case, since we have mostly DFIs as our LPs, they come with a technical assistance fund. So we can start with a certain amount, for example, $20,000 per company on technical assistance side. And if they make a good utilization of that amount, we can even increase that limit. So we have certain fund earmarked for technical assistance itself, which is not linked to the investment amount or investment return. It can come as a support or a grant to them. And on hindsight, many of our companies where we invested, they got a goodwill value because international FDI investor is coming into the company. So that gave them a kind of boost so that they had a better supplier and customer acquisition side as well. And on another side, where there are certain INGOs which were looking to work with the farmers. And when we were invested in a company which was into agriculture, they took them as their implementation partner, where they could help the farmers by providing hybrid seeds and other kind of expertise to the farmers, in which their supply chain got robust. So there are multiple aspects from where they can gain benefit from the PE firm, apart from just merely financial assistance or the fund. So you have to have a thorough understanding. There are multiple options with which from which you can raise your funds. So it's not a debt driven market anymore. So you need to be very smart regarding your capital structure, and PE option could be a very good option.
Thank you. Would you like to talk on certain topics that you feel have been left out from this event that would be helpful to our attendees?
Sure. No, absolutely. I completely agree with whatever Deepak has said. In fact, I would like to build on that. I think most people uh, think bucket debt and equity under the broader umbrella of financing or funding. And I think that's grossly erroneous because they are fundamentally very different instruments, not just from a collateral or an interest or what you have to sort of dilute perspective, but from the perspective of how each can be applied to build your business. And I think what really differentiates private equity or venture investing is the ability of active business and value creation. And I think that is what we really bring to the company. See, most of the times, we try and seek a board representative or a board seat in a company. And we do that for no other reason but to help the promoter think through his businesses from whatever years of and sector expertise that we build by investing in multiple companies. And we firmly believe that there are a lot of cross synergies that we can leverage from our portfolio companies itself. For example, in the beginning, I spoke about sectors and multiple companies that we've invested in those sectors, right? For example, in personal care, we've done Nykaa and Kama. In healthcare, we've done Polymedicure and Tylenol, and they're all leading companies of India. What we can do as investors is, of course, without breaching confidentiality norms, really leverage expertise from one company to another. Not only do we learn in that process, we also make the portfolio companies smarter and sharper about their own business. Because we firmly believe that entrepreneurship is not theoretical. You need to roll up your sleeves and really drive those operational improvements. And at times, the best way to do that is by seeing a precedence by companies who've done that in the industry. And I think our community acts as that cohesive hinge that does it for all these other, portfolios. So I think there are a lot of positives in raising and I actually wouldn't say raising money. I would say partnering with a private equity fund. And I know there are certain inhibitions as well. There have been cases in the past where people have feared, taking money from investors because they feel that it's intervention. They feel there is dilution of stake. But I would only encourage our audience to double click on this and really look at it more from a qualitative aspect, more from a partnership aspect than just from, a uses and applications of funds perspective.
Thank you, Vishvesh. Now, one question takes my mind that is it really true that it is very rare to see a public company that hasn't been through some sort of private equity life cycle before there are a ton of household names that have been at one point or another owned or are still owned by private equity managers? Is it true? What are your opinion on that, Vishesh?
So Hetal, I've seen, different kind of companies. I've seen family-owned companies, family-owned companies where, they're being run by the third or fourth generation. In the previous generations, they've amassed enough capital to continue the growth to the listing journey by their internal accruals. So they typically would not go for a PE investing because they do have to dilute a certain stake when an investor comes on board, right? On the other hand, I think most companies that are started by the first or second generation at some point do reach out to private equity investors to continue on their listing journey. I also think it is becoming increasingly important now because the market is flush with capital. At least the Indian capital markets are flush with capital and liquidity. And it then becomes a game of who can get, to that visibility faster. To deep dive on this, a trend that I'm seeing in the consumer space is companies spending increasing dollars on marketing, especially in India, in these D2C companies. We see, an HUL or a PNG, if you look at them, their marketing spends would be, 20 to 25% of top line sales. But if you look at these new age brands, let me take personal care as an example, all the new age D2C companies are spending as much as 45 to 50% of their sales on marketing. And to spend that kind of money, they need to continue raising money, right? And there are advantages in spending that money. I'm not dissuading them, because the more you spend, the more visibility you get, the more attention you get. But to spend that money, they need to raise that money. And I think at some point, they do reach out to investors to raise that capital. So I think I've seen both companies, but increasingly as capital is becoming more available and accessible, companies are going the private equity route, if not early, at least later in their stage to get to listing.
Mm-hmm. Okay. Deepak, would you share your thoughts on this quickly?
Okay, so here in Nepal, listing for the companies which has been approached, which has approached private equity, has not been happened as such yet, because private equity itself started in 2015. So one of the company which was into hydro, which raised a fund from private equity fund, is looking forward to invest, looking forward to go into IPO. But one of the problem here is, in most of the IPO cases, there will be 3 years of lock-in period, which triggers or hampers the exit of the PE firms. So due to the restriction on the after going for the IPO, due to the restriction on the lock-in period, which can go up to 3 years, there has been resistance from the PE firm itself to invest in a company which is looking forward to go into IPO as such, because most of them are already into their harvesting period as of now. But new PE firms which are which are going to be registered now on, maybe they will be looking forward to invest in a company which is looking forward to IPO, and they will be looking forward to IPO as an exit option. But to answer your question precisely, my experience here as such has been that the companies have not yet reached the IPO stage with the PE investment.
Okay. Thank you, Vishvesh. Thank you, Deepak. As this has been a very informative and a walkthrough sort of session for us and for attendees, I would like to thank you very much for being here today. And since there is no any further questions, so I would like to conclude this session. Thank you, everyone, for being here.
Thank you, Growcent. Thank you, Vishvesh. It was good.
Thank you, Growcent. Thank you.
Thank you so much, Vishvesh. Thank you, Deepak. Thank you.